Okay, we are live. I'm happy to talk to Wes Fulford, the CEO of Viridi Funds and the former CEO of Bitfarms. Wes, how are you doing today?
I'm wonderful. How are you?
Yeah, I'm fine, thank you. So let's start with your crypto story here. When did you start to move into crypto or into Bitcoin? And what is your story there?
Yeah, I started, I guess, taking a sort of deep interest in crypto in it's probably about March of 2016. I came to this business from a traditional financial services background and somehow have managed to sort of find my way back into that seat. But began my career as a asset manager and then investment banker for about a dozen years afterwards up here in Toronto, Canada, and was covering or leading the financial institutions investment banking group for Canadian Bank. And, the Canadian markets have always been early adopters of sort of nascent industries. I think the first publicly listed cryptocurrency mining company in the world was Hive in September of 2017. And, cannabis or early stage sort of traditional hard rock resource companies, whatever have you, the TSXV has always been a great place to launch companies and raise capital and have a public market for your stock. So I was covering the sector and sort of watching this, sort of backlog or queue of blockchain and crypto companies looking at accessing the public markets, and sat through a CFA lunch in November of 2016, and I was hooked. So hung up my banking hat in 2018 to join Bitfarms as a private company to execute a public listing, a path that the founders had put us on, and then pivoted the company back to Canadian markets from our original listing marketplace, just given that it was the wrong move initially, and had a fun time, interesting experience building and scaling Bitfarms to what it is today, and all the nuances that come with running a public listed company and governance and shareholder reporting and shareholder management, investor relations, et cetera, et cetera, et cetera. So here I am today. Launched Viridi with a partner, Ethan Veras, who I think you know of. And, we've got a product listed on the NYSE for about 2 months now under the ticker symbol RIGZ, RIGZ, which is specializing in investing primarily in renewable-backed cryptocurrency mining operations. And in addition to some of the semiconductors that are manufacturing the chips that support these rigs.
Yeah, I mean that's a great thing. I think it's the first Bitcoin mining ETF in the world, isn't it? Or
yeah, and look, if the sector was more evolved, like when you, I know you're well versed with all the publicly listed companies, but when you step back and look at the evolution, excuse me, of some of these names, most mining companies are anywhere between 6 months, a year old, 3.5. I think maximum 4 years old at this point, like in the public markets. Like they haven't been around for a long time. The sector's evolving rapidly. You're seeing, an RTO or public listing completed, at least a couple a month right now. We're on pace with some deals that were announced earlier this year. So if the sector was sort of more diverse, if there was more companies to choose from, we would probably be a pure play cryptocurrency infrastructure product, i.e. investing in self-mining publicly listed operations. But just given the nascency of the sector as it evolves, as the universe of potential holdings grows, just to satisfy sort of the regulatory environment of running an ETF from a diversification standpoint, naming conventions, treasury rules, all of the red tape that sort of gets layered on to allocating a portfolio. We sort of had to expand it into other infrastructure investments. But yes, to your point, your question, it is the most, probably the only quasi pure play cryptocurrency mining investment in the world in the public markets in the form of an ETF.
I mean, I think it's a great product. As you probably know, I'm invested big in these mining companies, and I have my little own model where I try to rebalance always, to move into the undervalued. So the question is, how are you doing this? I mean, it says it's an actively managed fund, so you're trading a little bit, and yeah, what are the numbers there, and when do you sell and when do you buy?
Yeah, like yourself, we're really keying in on those sort of valuation metrics that underpin fundamental value in some of these equities. And I think we share the same view that the markets are definitely somewhat inefficient as they evolve. There are miners out there trading at valuations that aren't justified, and others that are lagging the market leaders that should generally be outperformers should they deliver upon, the business plans, build the infrastructure required to support some of these large equipment orders, and create avenues to access capital to fund this expansion in a prudent manner. And it is an active strategy, and we are focused on exploiting those market mispricings. When we look at mining operations, obviously, the sort of core fundamental drivers of profitability are effectively, top two would be the efficiency of your equipment and the cost of your power. And then, beyond that, having sort of full control of your operations, your operational expenditures, like running your own infrastructure, managing your own uptimes, and not relying upon a third-party hosting facility and the margins that are baked into those hosting prices to sort of compress your operating margins. So we're keying in on not just current valuations, but ultimately looking at where these businesses are going to be 12 and 18 months from now, assuming the manufacturers meet the delivery schedules of some of the big equipment orders that have been announced and secured by these miners. But also looking at, a deep dive on our views on their ability to, create or build the infrastructure required to rack the equipment, in addition to the competency of management teams and boards to access capital at an effective or low cost rate. As a fiduciary of their balance sheet in the eyes of shareholders, just looking at sort of cash flow accretion or compute accretion on a per share value.
Nice. I mean, we're doing the same job. That's great.
Yes.
When I look at your ETF right now, I see that HUT is the biggest position with close to 15%. Mara is number 2 with 11%. Then Bitfarms and so on. So it looks like that, HUT and Mara, these are, as I'm aware of, the biggest hodlers of Bitcoin. I mean, Mara has close to 7,000 Bitcoins, should have HUT like 4,500, a little bit more right now. So do you value this hodl of the BTC? Is this important for you to make the position bigger there?
Yeah, this has been somewhat new, with the exception of HUT 8, who's been inventorying all of their BTC production basically since the inception of the business back in December 17 or Q1 2018 when they put HUT together. But you'll basically see the same sort of approach from all publicly listed miners in 2021. Everybody's been looking at alternative sources of funding to, fund an OPEX at the trade-off of basically inventorying all of their BTC and attempting to grow the digital asset inventories on their balance sheets. And I think that's, as the price moves or appreciates, obviously that helps them. The flip side of the coin is that, in a downward moving crypto market, this is punitive to the share price, but effectively what it's doing is underpinning the share price of some of these public equities, or helping to underpin some of the share price by having a digital asset inventory and a build up there.
Okay, yeah, that makes sense. I see that there's also a cash position right now of 10 or 11%. So I think, that could make the big difference in my opinion. So I'm very good in buying these stocks and holding, but not that good in holding cash to buy the dips. So yeah, I'm a hodler. So what is the strategy there with the cash? Is it always 10%, or do you want to buy the dip in a bear market, for example, or what is the strategy with the cash?
Exactly. Yeah. So looking to be strategic with our entry levels, or when we're increasing positions in various companies. The cash right now is definitely a little high versus where we want to be targeted long term. It's probably somewhere more like 1.5 or 2% cash. But over the last couple of trading sessions, as we've seen BTC tail off, and looking at sort of historical trading patterns, when you see weakness in the U.S. generally over the first few sessions of a pullback, Asia tends to follow suit. So in particular over the last couple of days, our view is that there'd be a little bit of price weakness to be determined in terms of where this stabilizes, but likely some more opportunistic buying opportunities versus levels we saw yesterday. And when I generally look across the universe of potential, our current portfolio and potential additions in the near term, I think that call was the right call.
Yes, definitely. I would be happy about a big cash position right now, to be honest. But okay, the price of Bitcoin is moving in bull and bear markets. We know this. Overall, on long term, it's one big bull market, that's for sure. But in the shorter term, and if you then you have a bull market and then a bear market most likely. So when you're focused on these Bitcoin mining stocks, most likely they will all go down in a bear market. So how do you prepare for this? Do you want to diversify more in a bear market into maybe the semiconductor industry, or what is the strategy here?
Yeah, we're running an active strategy. So certainly in times of like significant market volatility, it's well within our ability to move off positions and increase our cash allocations. And certainly, over the last couple of trading sessions, having a semiconductor allocation within the portfolio helps weather the storm. I think the common misnomer or misconception in this marketplace is people too often, generalist retail investor too often views these mining equities as a proxy for BTC. I think largely, yes, you could attribute some of the mining equities as a BTC proxy, much like you'd for some reason you'd buy a senior gold producer. You see a 10% pop in the underlying commodity, and the equity is up 20 or 30% because there's been a immediate and swift, assuming they're producing an immediate and swift increase to their top line with no corresponding increase to the bottom line or input costs required to produce that ounce. Same thing would apply here, absent a swift and immediate, increase in network hash rates. Periods of BTC price appreciation are torquey. There's high beta for the mining equities. But that being said, with the digital asset inventories on their balance sheets and the fact that most of the miners today at prevailing 30-cent revenue per terahash mining economics are making a lot of money. And especially if you are running new gen equipment at reasonably priced industrial scale power, if you just do the math that for a best of the best 30 joule efficiency miner drawing that amount of power 24 hours a day, using about 3/4 of a kilowatt of power to generate that terahash. If you're paying 4 cents or 5 cents for that power, let's use 4 for easy math, you've got a 3 cent per terahash cost of production just on an electricity basis, where you're getting paid 30 cents in BTC rewards revenue per terahash. So you've got 90% operating margins, and there is a real industrial scale manufacturing-esque style business that underpins these crypto equities. And even if you back up to mining economic conditions post-halving, 3-4 months post-halving last summer, there is a relatively or highly profitable business, like in comparison to any other sort of industrialized market sector, to have be running 50, 60% EBITDA margins, even in compressed mining economic conditions, is a pretty compelling business model, assuming management teams and boards are being good stewards of capital and not overpaying for hardware when they're scaling their ops.
Yeah, I mean, sometimes I have trouble to get the valid or actual numbers of all these companies about operational costs, because sometimes financials are delayed, and I mean it changed sometimes within days. When you see the gas price right now is surging like crazy. I think for miners with mining with gas, with electricity from natural gas, I mean, this could increase the cost significantly, but it's also dependent on the market and so on. So where do you get your numbers for all your calculation?
It's probably just 3.5 years of being quite close to management teams and business or mining ops that have been scaling. But I think in general, the management teams and boards are being encouraged to be more transparent. You've got pressures from media about, energy draws and sources of fuel powering these racks, in terms of their greenhouse gas emissions and carbon footprint. You've got pressures on boards and management teams to be responsible operators and good corporate citizens and scaling a renewable-based power. But generally, from a continuous disclosure standpoint, investors and media are demanding more. And there seems to be a trend around transparency and full disclosure. There are certain, with that being said, there are certain mining operators that have been more transparent than others. And some aren't, frankly, press releasing power pricing just because they're in operations where there's a lot of volatility around their sources of power and the cost of that power. So, in those scenarios, you're trying to use like backward looking information to predict power pricing going forward. But a lot of, the public equities outside of those specific names are, quite transparent and are operating in stable-based grids with predictable power pricing. So it really just comes down to dissecting the types of hardware fleets that they're running. And again, same comment. I think a lot of miners are being encouraged to, provide full disclosure on precisely what type of equipment they're running and the efficiency of that equipment or breakdown of that equipment.
Yes. Yeah, that's true. They're improving the transparency. I really like this.
Yep.
Okay, so back to the fund. Why should an investor put money into this ETF and not buy these stocks for himself?
Look, outside of individuals like yourself, I don't think the vast majority of retail and institutions, or retail certainly, buying cryptocurrency mining equities or running models, trying to break down their operations and their hardware portfolios and dive into power pricing and sort of operating margins, or have the generalist knowledge of mining economics and the drivers of those economics. The nice thing about mining economics is you've got really 4 variables impacting your daily revenue, which is BTC price, difficulty, block reward, and transaction fees. There's only one of those variables that's changing minute to minute, which is BTC price. And you can, in our view, use sort of historical economics and diagnostics on sort of network hash rate and types of like where the big regions are, what the average prices in those regions are, what types of equipment are being run on average across the network to create some assumptions around cost base for miners, which you can factor into that analysis. So I think, drawing upon our experience in traditional financial markets, having built, I mean, personally, I can't tell you how many cash flow models I've built or comparable companies valuation analysis I've done over the years. It's in the thousands, and layering on that's sort of the core operational experience, building and scaling and operating industrial scale data centers and cryptocurrency mining operations. I think, the market mispricings are quite evident, and they might not be as apparent to the average retail investor. And, with an active strategy, product managed by a team like those at Viridi, I think our ability to exploit those mispricings and outperform the sort of basket allocation that a lot of people are taking towards this sector should be better off in the long term. You've got the benefit of obviously an ETF and being registered account eligible. Not that an equity wouldn't be, but registered account eligible, liquidity through the exchange, transparency about our portfolio holdings and allocations being run by a group that has that financial and operational background in this sector.
Yeah, very interesting. I think that makes a lot of sense. What are the fees for these ETF?
It's an actively managed product, so obviously we're trading more than a passive index-based ETF. So with that comes a 0.9% management fee, which in the broader scheme of things, if you're
so it's below 1%.
Correct.
For a year, then I think.
And that's pretty consistent with every active management product, and especially in this sector.
Yeah, I mean, when I look at the performance, I think you started at the right time, at the bottom, more or less, in July. So it's up, I think, like 40% or so since inception, 48%. So this 0.9%, I think it doesn't matter anymore if you started from day one.
Yeah.
So it was a good time for start. So I see the assets under management, they are rising very fast. It's now approximately 10 million. What are the do you have some specific institutional investors? Is there any interest from the institutions right now?
Yeah, it's tough to get the institutional investors involved in a product like this without having that historical track record and history of performance and size. Those are sort of the three tests required for an institution to make an allocation to a product like this. So, the nature of the ETF business is just sort of, get it registered. You go through the regulatory hurdles with the SEC to bless the listing and get it trading, and then you sort of set it loose and just focus on obviously, managing the fund and generating strong performance, which you can speak to and market on, but just getting the word out there through podcasts like this and others to get more eyes and attention on the story, and the kind of AUM growth comes to you generally naturally and organically through those efforts.
Yeah, I think the retail investors will be first here. Great.
Yeah.
Okay, so we have 3 minutes, so 2 last questions. First of all, what do you think about Bitcoin mining in North America? I mean, I think most or all of these companies are based in North America. So it seems like you're bullish on this sector.
Yeah, what happened with the exodus of hash rate and shutdowns in many mining provinces in China in June was obviously advantageous. I wish I was personally owner and operating an exahash portfolio of mining compute in North America, because the last several months, there are some outsized returns available as they become a bigger component of the networks. And I think just given how well the public markets have played out in terms of access to capital, which is critical in this sector to continue to scale and outpace network hash rate growth, and i.e. maintain your ownership or increase your ownership of overall compute. There's going to continue to be lots of jurisdictional expansion within North America for these publicly listed mining companies. But needless to say, I think all groups will have to consider to look abroad as opportunities present themselves for reasonable jurisdictional risk and low cost power.
Okay, great. So what is on what miner are you most bullish right now? On what mining stock?
I'll just speak in generalities on that one. I think there are some Canadian equities that have recently, made their way into the U.S. markets. And when you look at sort of multiples relative to the big guys in the U.S., there's still a lot of room to go from a catch-up basis. I'm looking forward to the day when it's not the stock twits and other, chat forums driving public market multiples, and the rubber hits the roads from a financial and operational standpoint to underpin the equity values. So and that will come, which just speaks to how timely and opportunistic our launch was, because the mispricings are evident in our eyes, and I think we can take advantage of that and exploit those opportunities.
Great. So last question, where do you see Bitcoin in the end of this year? So the next 3 months, what is your expectation here?
Look, I don't want to say like technical trading analysis is irrelevant, and it becomes an even more difficult question as you sort of layer on the overall, financial institutional angle. This becomes less sovereign through the use of derivatives and other protocols and lending applications, et cetera, like driving volatility. But I think my sort of price forecast over the next 12 months is probably about 2.5x where we're currently sitting. I tend to revert back to the stock to flow model as my source of price predictions and ultimately long-term BTC appreciation. But where we're going to be in 3 months, who knows? I hope we're at 55 or 60K, but it could be sideways. It could be down 30%. At the end of the day, it's not going to impact our approach to portfolio allocation. Just speaking back to the industrial nature of these operations, their ability to be generating revenue and positive margins, even in a compressed situation, but long, I'll call it near term, 12 months from now, somewhere around 100K, it'd be where I'd expect to be sitting at for BTC price.
Yeah, great. I mean, the miners, they will get more hardware also online, and with a lot lower prices of Bitcoin, they will be still very profitable. So I'm not concerned about this. Okay, so Wes, you have to go to the next meeting. Thank you very much for joining. That was a great talk, a great interview. And yeah, hopefully see us in the next one.
Sounds great. Thanks for having me.
Okay, bye.
Okay, cheers. Bye-bye.